Welcome to our special preview of Invest 2025, a global streaming event packed full of conversations with CEOs and leaders to help you, the investor. Today's the big day. Stay locked into Yahoo Finance for a day of unparalleled insight starting right in London right now on the pre-show. Beyond the big headline that the longest ever government shutdown in US history is now over, we'll also be hearing from one of the world's most respected economists on what the future of markets could look like. And our executive editor, Brian Sozzi, will introduce the most important stories for forward-looking investors. So, welcome to Invest, grab your coffee, and let's own the morning. We're going to hear from our executive editor, Brian Sozzi, in just a moment. But before we do, I want to catch you up with the top headlines before the opening bell rings on Wall Street. Let's start with a quick look at where US stock futures stand. And it's looking like it will be a pretty negative start to the trading day, and that's perhaps down to the main story of the day. The longest government shutdown in US history is finally over. President Trump signed the legislation to officially mark the conclusion to a 43-day impasse that halted food aid to millions of households, cancelled thousands of flights, and forced federal workers to go unpaid for more than a month. It's also shaken markets and had long-reaching economic effects. In recent days, markets had been rising as hopes for an end to the shutdown grew. Next up, let's focus on earnings, and the big one out just now, Disney. Now, on the face of it, a bit of a mixed bag. Q4 revenue of $22.46 billion missed estimates, but adjusted earnings per share of $1.11 came in better than expected. Disney's linear TV business continues to struggle, but much of that weakness was offset by strength in its parks and streaming businesses. In the pre-market, shares of Disney are down over 3%. Now remember, Disney is in the final stretch of CEO Bob Iger's turnaround strategy ahead of his planned departure next year. And sticking with earnings, after yesterday's closing bell, Cisco reported earnings, and that's had quite the impact on its share price. Just have a look at this. Shares are up around 7% in the pre-market. Cisco is benefiting from strong AI-fueled equipment demand. It's a key supplier to cloud enterprise and telecom customers and has been riding a wave of AI-driven infrastructure spending. Well, speaking of AI, that's just one of the themes we'll be exploring during Yahoo Finance Invest 2025. And I'm pleased to say I'm joined by our executive editor, Brian Sozzi. Brian, thanks so much for joining us. Well, I talked about AI, but there's a lot of big themes that we're covering today for Invest 2025. Let's start with another one. Let's start with crypto. One thing here in the UK and other parts of the world has been that up to now, the regulatory environment's not really been the most conducive, let's say, for retail investors to get involved. But that's certainly not the case for the US, is it? And who are we going to hear from today?
Ramzan, so great to see you here, and thanks for that tweet or post this morning. I mean, that's fabulous picture reporting right there, my man, on a big day for Yahoo Finance and Invest. But to your point, crypto, look, this is the year that Bitcoin has gone mainstream. It hit record highs of about $126 a coin a couple weeks ago. Now, what I'm most concerned about, Ramzan, is what is the pullback in Bitcoin? What are people saying about it? And to that end, we're starting right at the top of the show, Ramzan, very soon with Michael Saylor, the Bitcoin king. He's been one of the biggest bulls in the markets on all things Bitcoin. I need to hear from Michael Saylor if he still is that bullish. By the same token, later in the day, Ramzan, talk with Robinhood co-founder and CEO Vlad Tenev. Crypto has been a big portion of the reason why his stock has gone through the roof this year, in part because his financials have gone through the roof.
Yeah, and another big theme we're going to talk about is artificial intelligence. We've seen worries surface in recent weeks about a bubble. I know you're not a fan of that term, are you, Brian?
No,
but,
Robin,
again,
I'm not.
There's some big names in that space that people are going to invest, right?
I hate the word bubble.
What questions are you going to ask these guys?
It's just my thing, Ramzan. You're right on. I don't like the term bubble. Most people don't even know what in the world it even is. Nonetheless, we're going to put to a lot of our guests here today at Invest what their thought about AI valuations are. Are they too high? If they are not too high, how much higher can they go? But besides that, Ramzan, will also be drilling down into the impact of AI in the U.S. labor market. So many fears about AI taking human jobs. We're going to be talking to Lael Brainerd, former Fed governor. Really excited to talk to Lael and get her thoughts on the impact of AI in the U.S. labor market and the future of the jobs market.
Yeah, AI is certainly driving Cisco prices higher today. It's really fueled quite a lot of the rise in the stock markets we've seen this year as well. And markets, it's fair to say, have had pretty good 2025. But, I spoke at the top of the show about economic data, which we don't have a full picture yet, and it doesn't seem to really reflect that bullishness, though. Why is that?
Right, Ramzan. We haven't gotten any economic data for months, in part because of that record-setting government shutdown here in the U.S. that has been officially ended. Look, we may not even get any of this data over the past few months. We've heard Kevin Hassett, who is a contender to lead the Federal Reserve as chairman, say, look, might not get this data. Let's keep it moving. At the end of the day, I think a lot of the economists that I've talked to ahead of Invest, Ramzan, are worried about the near-term direction of the economy. Prices are high. Coffee prices are high. Food prices are high. And the consumers are adjusting. I can't tell you, Ramzan, how many CEOs have told me that they are concerned about the near-term outlook in their business because of the higher prices. Again, we're going to put the question on where prices go next to the likes of Lael Brainerd. Robert Smith, billionaire investor who investing in tech. He has a great read on all things U.S. economy as well.
And talking of economists, I know you've sat down with one of the most well-renowned economists, Mohamed El-Erian. What can you tell us about that?
Yeah, well, I'm not going to give the whole interview away, Ramzan, okay? Mohamed was game on
it's coming
for
up
us
shortly.
here. Yeah, it's coming up shortly, but I will say this. I think Mohamed was on point on what he had to say, that some big changes need to happen to the Federal Reserve. I share his concern on the economy, Ramzan, and I think that's one heck of an interview that we're going to start off here with at Invest.
Brian, it's always great to talk to you. Time now, though, for a quick break. But after that, we'll be checking out Brian's interview with Mohamed El-Erian, one of the world's most prominent economists and former CEO of PIMCO. Watch this space. Welcome back. So, as part of Invest 2025, we'll be speaking to some of the biggest names from the world of crypto to AI to the economy. One of those is Mohamed El-Erian, former CEO of PIMCO and now Chief Economic Advisor to Allianz. He spoke to my colleague Brian Sozzi for a wide-ranging interview, everything from the independence of the Federal Reserve to how AI could impact on productivity. First question, what keeps him up at night?
So let me just say, we will have cockroaches, but not termites. And this is a fundamental differentiation. Cockroaches are unpleasant. They come in groups, but they don't eat away at the integrity of the system. Termites eat away at the integrity of the foundation. So why are we going to have cockroaches? We're coming from a period where people have stretched really far for additional returns. They have been encouraged to do so by a strong economy, by very loose financial conditions. And some people went beyond their comfort zone and beyond their ability to do due diligence. So I don't think we should be surprised that we will have these accidents, these credit accidents. We'll have some economic accidents, but I don't think we're going to have any systemic shock.
That is, of course, a good thing. And when you mention potential economic accidents, what keeps you up at night? Well, what are you most concerned about for 2026?
So what used to keep me up was a trade war. But the US has been able to impose higher tariffs without triggering much retaliation. So that doesn't keep me up as it used to. What does keep me up is what's happening at the lower ends of the income distribution for households, where there is significant pressure. And what keeps me up is the amount of debt that has to be refinanced at higher interest rates. So those two things are potential areas of pressure, which would be made worse if we get a policy mistake.
Mohamed, you bring up a really great point. It's something I've been thinking on very deeply of late. We've seen tremendous wealth created in the market this year, and the bull market has continued, but we're not seeing it. I guess this goes to your point. We're not seeing it translate into that average U.S. household, that lower income consumer. Is that cohort of the U.S., are they in a recession?
They're near recession, and they are spreading this concern about affordability, which is not just an economic issue, it's a social and political issue. The first shock to affordability was, of course, the 2021-2022 inflation shock. But that was offset, Brian, by income transfers. Now we have inflation stuck at 3%. We have insecurity about future income. The Challenger report showed you that layoffs were surging. AI will change the workplace. And in addition, we have high debt and credit cards that have been maxed out. So there is real concern on the bottom bit of what people call the K-shaped economy. And this is not isolated concern. If the lower household incomes stop spending, not because they don't want to spend, but they're not able to spend, that will contaminate upwards for the economy as a whole.
So you think that pressure on the low end, so the high income consumer, the person that is exposed to the markets, they've enjoyed a good year, they're not immune to what's happening on the low end.
So they're doing fine. They're doing fine from an income perspective. They're doing fine from a wealth perspective. So I'm not worried about middle to upper class. I am worried about lower income households and their ability to continue to navigate this uncertain environment.
How do we bridge this gap? Because if you listen to the current administration, Mohamed, they are talking, the president has floated a potential $2,000 dividend. There's been interest in that. The one big beautiful bill was passed. More jobs are being created in the U.S. in terms of tech companies building out AI data centers. Like, how do you bridge that gap between what's happening on the high end and low end?
So they also, you could have added to that list that they've moved on some very sensitive prices, gasoline being one, and the other one being some pharmaceuticals. So they are taking steps, Brian, but this has been long in the making. This is not something that is recent, and therefore it is deep-rooted. It is made more complex by two other issues. One is the difference between real and perceived, and the other one is the difference between relative and absolute. So it is a really complicated issue, and if you go through it, the bottom line is it will take years of effort, both on the income side and the price side, to get us out of these situations.
I want to leave enough time in this conversation, Mohamed, because you are known as a foremost thinker on Federal Reserve policy. It has been quite the year for all things Federal Reserve, of course. Attacks from the Trump administration. We're coming up on the end of Chair Powell's tenure. Where is your head at as it pertains to the Fed in 2026? What is a new Fed chair? What will they bring? And where do you see the ultimate end game for rate cuts this cycle?
What a new chair will inherit is a divided Fed. And it's divided by two things. One is whether they are sensitive to the employment side of the dual mandate or to the inflation side of the dual mandate. Both are flashing yellow right now. So it does matter where your bias is. And what we see is that people are on both sides of this divide. The second thing that they will inherit is a division between people who are totally comfortable being backward-looking, so-called data-dependent, and those who realize they also need to be forward-looking. They need to have a strategic view of the economy, and in particular, Brian, of something you've been talking about a lot, AI and its impact on productivity and growth. So what a new chair has to bring is a unifying narrative. And I think that narrative has to be forward-looking. And the new chair has to have a view as to what the future economy looks like. I am a great believer, as you know, in the promise of AI. If we get diffusion right, we will have a significant productivity increase. And as a result, monetary policy will be able to be looser than it would otherwise have been.
Do you view the attacks on the Fed and what it does for the administration, will that leave lasting damage on this institution? And if you do think that's the case, what does that damage even mean to markets?
So I believe deeply in the independence of the Fed, deeply, that I think a Fed with policy autonomy is the best thing we can have. But I also believe, as you know, that this Fed went to sleep. There are many areas of reform that require attention. There are many best practices that from the rest of the world that we should be looking at more seriously. And there's lots of hard questions that we need to ask, including what is the right inflation target in a structurally changing economy. So the good news is you're starting to hear debate from within the Fed. You've had two federal officials, as you know, come out and saying, maybe we should have a range for inflation, our inflation target, not a point estimate. You've had another one come up saying we target the wrong intermediate policy variable. So I'm encouraged by the fact that the Fed itself is now finally talking about reforms. And that is something that, if you look at the 5 candidates on the short list, all of them understand that you need to reform the way the Fed operates. Otherwise, the Fed will continue to be behind. And if you look at the recent years, not only have we had decisions that were too late, but we've had a culture issue. We've had 5 officials that were accused of irregularities. So I think it's really important to reform this Fed. And what this political pressure has done is it has made certain Fed officials realize that it's better to reform from the inside than to have it imposed on you.
The 5 contenders you mentioned on the short list for the next Fed chair, do you have confidence that they will keep the Fed independent?
I do. I think all of them understand the history of central banking. They understand the importance of keeping the Fed independent, but they also understand that an independent Fed needs to be an accountable Fed, and an independent Fed needs to reform itself to keep up with changes. It is striking to me, Brian, that we don't have external members serving on the FOMC, like the Bank of England does. So we end up with groupthink, and that groupthink ends up by the Fed being behind. We saw that in 2021, 22, and we've seen it again this year. So there are things that can be done and should be done. And I think that all 5 realize that an independent Fed is critical, but it doesn't mean a Fed that goes to sleep on how it operates.
Do you think the 2% inflation target should be scrapped?
I don't think it should be scrapped. I think it should be changed. I have been of the view that a better inflation target is a range, not a point estimate. A point estimate suggests precision that is elusive. Second, that range should be higher than 2%. It should be the 2.5% to 3%. And what is undeniable is that we are at a stable 3% inflation, and that hasn't in any way unanchored inflation expectations.
Out of the 5 candidates, Mohamed, look, I agree with you. These are incredibly qualified people. Of course, shout out Rick Reeder, friend of Yahoo Finance. We all know him very well. What do you think their biggest problem they will have to solve? That first 6 months on the job of leading the Federal Reserve after a long tenure like Jerome Powell has had, like, what do they need to get right out of the box?
Shifting the Fed from an excessively data-dependent, backward-looking institution that is reactive to one that has the confidence to take a strategic view and be proactive. That's going to be a major change that is really needed, has been needed for a while, and that hasn't happened under Chair Powell.
I wanted to get back to what you mentioned on AI and productivity. You can see AI chatbots, at least for now, this current wave of innovation is already starting to drive a lot of productivity. How much of a risk is it to jobs around the world? How concerned are you?
I'm concerned mainly because of the corporate mindset, Brian. If you look at the promise of AI, there is a labor displacement risk, and there's a massive labor enhancing opportunity. And the worry I have that with the exception of a few companies, the mindset right now in corporate America is about cost minimization. AI is viewed as a cost minimizer. What AI really is an enabler, a productivity enabler that gets there from better work and more work. And I worry a little bit that the mindset is too focused right now on cost minimization, because the real promise of AI is not labor displacement, it's labor enhancement.
I told myself coming into this, Mohamed, I didn't want to be that guy that asked you about a bubble. I just think it doesn't capture the nuances it deserves. So let me, if I can frame it a little more academically, how concerned are you that AI stocks are grossly overvalued?
So let me share the work that I've been doing with Mike Spence, a friend and a Nobel Prize winner. We believe that we are in a rational bubble. So yes, there are elements of a bubble. And there's 3 elements in particular of this bubble. First, the frontier, those working on foundational models. Not all of them are going to succeed. And yet all of them are attracting significant investment. Second, diffusion isn't being talked about enough. Diffusion means getting AI into the workplace in an orderly fashion, in a comprehensive fashion. We don't have a diffusion policy so far. Other countries, China does, UAE does, we haven't. We've got to get diffusion right. Otherwise, the promise of AI is not going to be fully realized. And then you and I remember the dot-com era. We remember companies simply putting a label on what they do and attracting investment. Well, that label today is AI. So there are elements of a bubble, which means that people will end up with losses. But the aggregate value of what's being created is significant. And therefore, the rationality part comes in, Brian. It makes sense to take a venture capital approach to AI. The payoff is so large that it is rational to have multiple investments and to overinvest. So the good news is that it's a construct that will make us more innovative, more competitive. The bad news is there will be tears, there will be losses, because elements of it are elements of a bubble.
I wanted to leave Invest viewers thinking with one deep thought. And let me come at you with this question, Mohamed, before we get going here. If you were writing a short message to policymakers right now, one key action they should take, what would it be and why?
That realize that our future is going to be at the tails of distribution, not in the belly. You know, for a long time, we grew up with unifying themes, the Washington Consensus, globalization. We are now living in a world of fragmentation, in a world that structurally changes. And what happens at the tails are going to determine where we end up. So don't get fooled by a normal distribution, a bell-shaped distribution. Realize we're in a multimodal world.
Well, that was really fascinating stuff there from Mohamed El-Erian, speaking to our executive editor, Brian Sozzi. Well, Mohamed made it pretty clear that he believes investors really need to keep a close eye on the challenges of affordability, which he thinks are set to accelerate, especially as employees worry about workplace changes related to artificial intelligence, which, yes, on the one hand, are likely to increase productivity, but on the other hand, could have quite an impact on the labour market. Another thing that's pretty clear from that was Mohamed's view that the Fed still needs to remain independent. And it's interesting what he had to say about data too, something we hopefully will have a lot of more pretty soon, though, as Brian was saying earlier, that looks unlikely that we'll have anything as soon as we really, really want. Okay, let's have a look at where the markets stand before the main bulk of our Invest All Day today begins, led by, of course, our colleagues in New York. I'll start with some of the markets, the crypto markets, and Bitcoin is down over 2% today. Actually, Bitcoin is struggling to stage a meaningful recovery after last month's stumble, with signs of fatigue continuing to mount across crypto markets. It'll be really interesting to hear from Michael Saylor for his views on Bitcoin. That's coming up on Invest. Gold prices are edging higher, about 0.5% higher, still well above the 4,000 mark. In fact, just over $4,200 an ounce mark. It's not quite hitting those highs, though, of 4,300, but certainly moving in the more positive direction. And it's been a broadly positive sentiment prevailed in Asian markets earlier. They were tracking that positive sentiment created by the end of the longest ever US government shutdown. Also, Chinese government's plans to unveil a comprehensive strategy to boost the new energy battery industry and enhance related infrastructure also supported sentiment there too. European stocks, well, initially were higher, but they are now slipping back into the red. They were tracking the Asian markets, obviously, after on the news of that US government shutdown coming to an end. Only France, the positive one there. The FTSE in London is falling pretty dramatically. We had some pretty bad GDP data out this morning, but one outlier was Burberry. Its shares are flying after it reported comparable store sales growth for the first time in 2 years actually grew. All right, let's check to see how Wall Street will look as well. And it looks like it will be a slightly negative start to the trading day as traders grappled with the outlook for interest rates after the longest government shutdown in history came to an end. Wall Street certainly still has questions about the state of the economy. That's it for the Invest pre-show this morning. Stay with Yahoo Finance for a bumper day of thought-provoking programming. You can also live stream Invest 2025 on YouTube and other platforms. Remember, there will be names like Vlad Tenev, Michael Saylor, Alex Karp from Palantir, and many others you don't want to miss. All the insights coming today to get your portfolio ready for 2026. I'm Ramzan Karmali. Go own the morning.